Coming up today, stocks bounce back as the government looks set to reopen. The market's still full of fear. Job creation pretty close to zero. The latest on earning. The McGroup is coming back. A socialist takes over New York. And why us retail traders aren't done with this bull market just yet. It's going to be a good one, guys. Let's go. Welcome back, everybody. I trust you've been well these past 2 weeks in my absence. As we've been completing our house move, you'll be happy to know we're all settled in now. I'm back in the hot seat, fired up, ready to do the daily market review every day after market close. For those of you that are new here, welcome. My name's Jared, and every day after US market close, I break down all the most important news, data, and events for your benefit. And quite a good day to come back into the office. Very bullish moves across the board. Stocks, commodity, cryptos all finishing higher on quite a good bounce back. After what looks like a shallow dip on the S&P 500, giving us a powerful hammer formation there on Friday. The dip was bought. There's more a story in high beta name. Small cap growth really got hammered these last couple of weeks. See that in the meme ETF. In fact, on Friday, it was almost 30% below the 50-day VWAP, and we're getting a good bounce here across the board, along with a healthy VIX crash to start the week as we head into this bullish seasonal period. And why we're getting a good bounce today is there's signs that the US government may be close to reopening again. After reaching a record of the longest US government shutdown in history, we've now got Senate lawmakers moving to advance a federal funding bill, and that's really turned on the risk-on appetite today, especially in growth-sensitive names and sectors, AI, crypto, and even commodities as well. We've got prediction markets now pricing in. US government should be reopened this week on the 14th. 92% odds we do see it happen by this Friday, which historically speaking is a great thing, as typically when the government does reopen, we can often see a bit of a relief rally coming out of that, and especially the forward 12 months once the shutdown is over. But as usual, the mainstream media is at it again, trying to fill our heads with fear, keeping many investors sidelined as they're always screaming pending doom. The big crash is coming, and I believe that is having an effect on many investors, small and large, this entire year. In fact, 2025 is unlike any other year. Looking at the difference of the AAII Investor Sentiment Survey of bulls minus bears, that's been consistently negative. In other words, more bears than bulls this year, which is typically associated when the market's having a down year looking back in history. So there is a massive divergence going on with market returns and investor sentiment that is still present today. In fact, Friday we finished in the extreme fear zone. Looking at the fear and greed index, we just jumped back into the fear zone as of today's close, and the market's only a few points off all-time highs, but there is plenty of reason for optimism, including one of the biggest pain points for the market this year. A trade deal between the world's two largest economies was recently reached, US and China, agreeing to de-escalate tensions and kind of create a managed competition agreement. By no means the end of it, but definitely a positive step towards de-risking important issues like rare earths, lowering tariffs, and China agreeing to buy large quantities of US agricultural products, with signs that we should also see a new trade deal with another large economy, India, as they get ticked off one by one, just after we saw a good one with South Korea a few weeks ago. And even though inflation's still ebbing and flowing as usual, it's still nowhere near the heights that we were told it was going to reach this year by the so-called experts and mainstream media. According to Trueflation, a private company which actually tracks 10 million plus real-time prices in the US economy, it's still tracking around 2.5%, which is still very much an acceptable level. And because the jobs market is still very weak, in fact, US job openings continue to decline. And like Jay Powell recently said, job creation is actually pretty close to zero, acknowledging that AI is having a material impact on the US labor market. And even saying that unlike the dot-com boom in the late 90s with internet companies, AI spending isn't a bubble. And he's right, because there is key differences, because back in the late 90s, a lot of it was hype. Investors were correctly looking into the future and seeing the huge growth of the internet, but the revenue and the earnings weren't there. Fast forward 25 years to today, not only is the earnings there, but there's simply not enough supply when it comes to GPUs and data centers. The demand is already overwhelming it. It's set to grow further. So it was interesting to hear Jay Powell acknowledge that as well. And the AI trade is very much alive. We saw that today across the chart in all layers of this AI boom, which you could kind of think of it as 5 layers, like Jensen Huang laid out. The first being energy. Can't do anything else unless you've got the energy for it. That's why we've been seeing good performances this year in new age energy, electricity, uranium, nuclear, GPUs, AI infrastructure, AI models, finally application. With stocks like Palantir up big today, 8.8%. Nvidia just a few points off all-time highs, up over 5%, and related ETFs as well. The Global X Artificial Intelligence and Technology Fund, AIQ, reclaiming its 50-day VWAP. As we now make our way to the back of Q3 earnings season, which has been a pretty good result. 82% of companies have reported earnings per share above estimates, well above the 10-year average of 75%. And not only are corporate profits in absolute terms at all-time highs, but so are corporate margins, continuing their secular trend higher, on track for a record in Q3, now around 13%. And it's actually small caps, the Russell 2000 index, expected to have huge earnings growth over the next year in excess of 30%, which lower rates will definitely help with that. Although the market's still not sure whether the Fed is going to cut, currently priced in a 64% chance. But there are a few Fed members that definitely want to see a cut. In fact, Miran wants to see a half a point cut. But there is a high level of disagreement between Fed members. Been seeing a record amount of dissent this year. But nonetheless, the path for rates is still lower, and that is very much bullish. The economy doesn't go into a recession, and the Fed can cut rates because it can, not because it has to. The market typically does pretty well over the next year or two. And speaking of the Fed, they're also about to end their quantitative tightening. In other words, reducing their balance sheet, the amount of liquidity they pump into the system. Not out of an emergency, but just to recalibrate their plumbing in the banking system. Still adjusting from events 2020. And this too is very bullish for market as they now stand ready to do quantitative easing. In other words, increasing their balance sheet, increasing liquidity in the financial system. In addition to all that, the current admin's floating the idea of a $2,000 tariff dividend to help low and middle income consumers who are still struggling with high bills, structural inflation, and high rate. And this too is very bullish. The last time this happened, back in 2020, the market ripped, will no doubt benefit brokers like Robinhood, as a lot of this money, if it is paid out, will find its way into the stock market, and especially those high beta names, small cap growth stocks, which have had a pretty good flush out the last couple of weeks. Even JP Morgan says investors should buy any dips as the bull market rages on. All the fundamentals are there: earnings, rate, technical momentum, GDP still holding up. All the fears over tariffs and inflation have pretty much gone away. And on top of that, we've got the McRib coming back to McDonald, which, believe it or not, is actually another bullish sign for the stock market. Historically, the S&P 500 has a higher daily return when the McRib is available. And even perma-pessimist Ray Dalio, the guy is always going on about wealth inequality being a problem, even though he's an extreme wealth hoarder himself, says the stock market's headed for one last hurrah before the bubble bursts, with plenty of billionaire hedge fund investors like himself thinking this market's similar to 1998 or 1999 and could be on our way to one last vertical melt-up, as for sure all the ingredients are there. And even though we're at records in terms of CAPE ratio, price to book, price to sales, looking at a long-term trend line of the market increasing 10% per year, we're actually not that far above it compared to the late 90s, those last couple of years. Before it finally topped, were really spectacular, especially in the NASDAQ and tech stock. And that would also line up with a few other cycles, overlaying the three major secular bull markets of the last 100 years with a sine wave analysis would also suggest the market could have a year or two left in it before rolling over. Goldman Sachs came out and said, watch these 5 warning signs to know when the AI craze is peaking. First, a peak in investment spend. By looking back in the late 90s, that actually rolled over after the market rolled over. Market topped in March 2000. And right now, tech capital spending is still off the chart. It's actually accelerated this last year or two. Corporate profits starting to fall. We still haven't seen that yet. Like I just showed you, margins at our all-time highs. Corporate debt rising. The debt picture for companies is actually pretty good. Like a lot of Americans, they locked in rates when they were low a few years ago. So balance sheets are very healthy. Credit spreads are low. No signs of distress in credit markets. Just a few isolated pockets. For some companies leveraged to low-income consumers. So there's no warning signs from credit markets. And we can see that in the price action of high-yield corporate bonds. Holding up pretty good. And I'd say the 10-year yield right in the sweet spot at 4.12. We don't want it too high. Causing a high cost of financing. We don't want it too low. The bond market screaming recession. So I'd say overall the bond market is quite healthy, but still a bit of work to do looking at market breadth and the percentage of stocks above the 200-day moving average, 55% here. So even though the indices pretty much at all-time highs, mega cap tech just been doing so well for a few years now, we've still got a lot of stocks that are well off highs, which can be looked at in both ways. You could say it's a bearish divergence from the market, or you could say there's plenty of room for catch-up amongst a lot of stocks out there. And looking at proxies for risk and liquidity like Bitcoin seems to have found support around 101,000. I think Bitcoin, along with Ethereum and other cryptos, could be setting up for a monster rebound and rally into year-end. The prospect of lower rates, increased liquidity, not only in America but around the world, that is all very bullish for crypto, along with more pending deregulation and support from the US government. Low allocations from institutions, along with relatively low bullish sentiment from retail investors in crypto as well. I think any further dips could get bought and may represent good opportunities. But just moving on to a few more things before I wrap it up. The Queen of Wall Street has retired. Nancy Pelosi no longer going to go for re-election in Congress after being there for almost 50 years. In that time, her and her husband outperformed the Dow Jones Industrial by 17,000%. And like this comment below the post said, their first year in Congress, their net worth was $785,000. Now net worth is closer to $200 million. You'll be hard pressed to find anybody, including hedge fund managers, that have similar returns. Just a coincidence, right? I don't think so. And speaking of hypocrites, just on to the new socialist mayor of New York, Mamdani. Very well spoken. He's managed to woo over millions of voters, but he comes from anything but a socialist background, actually raised in a very wealthy family. Privileged kid, going to prestigious schools. He's now dangled the candy in front of his constituents, winning the vote as a self-proclaimed socialist, now leading the world's #1 capitalist city. And even though I have a small platform online, I believe it's still worth giving voice to, just like others have, as we shouldn't sit in silence and just watch yet another Western city go down the toilet, as it does have an effect on us investors. Just look what's happened in London. Stock market's done nothing for 15 years. And so I've heard people online say, how did this happen? Us logical thinking humans know what happened with socialism. We've seen it time and time again throughout history. It always failed. It never works. And although capitalism isn't perfect, it's infinitely better than socialism and its close cousin, communism. And so in my opinion, how this happened is mainly two things. Like I just asked GPT, research the latest data and give a quick summary of New York City's immigrant population percentage, what percentage don't speak English, and also what percentage of New York City residents don't own real estate. So according to the latest stats, about 37% of New York City residents are immigrants, and about half of them don't speak English at home. And like Elon Musk says, you import the third world, you become the third world. And that's how the woke ideologists stay in power. Through importing the third world, they keep voting them in. And why Elon also said, if Trump didn't win the last election, it would have been the last real election in America. As up until a year ago, America didn't have a southern border. It was a free-for-all. But it's not just that, it's also a wealth inequality problem as well, for sure. Plenty of millennials. As according to the latest stats, 69% of New York households rent. They don't own their own property. Many young people don't own real estate, don't own stocks. They're not a part of the capital system. Quite often when you're not a part of the capital system, you naturally turn against it. You want to pull down those that are. And I believe it's these two reasons as why we've seen a socialist leader take control in New York. Because if you compare these stats in New York versus the rest of America, 37% of New York residents are immigrants versus 14% for the rest of the country. Half of New Yorkers don't speak English at home versus 22% for the rest of the country. And same deal again with real estate ownership. 69% of New Yorkers rent versus 35% for the rest of the country. And so apart from having logical immigration policy, not allowing a free-for-all from the third world to override the West, what else is needed is to encourage capitalism. Like Brian Armstrong, the CEO of Coinbase, said today, we need more capitalism and less socialism. I know the White House floated an idea of giving every newborn American $1,000 in S&P 500. I think it's a great idea. But also financial education, which is really lacking in all curriculums across the world. Otherwise, I fear New York may go the way of London, Paris, Brussels, and other European cities that have adopted aggressive immigration policies. And again, it just shows up in the data time and time again. You look at Poland, adopted capitalism, very low immigration, for which they're far better off for it in terms of productivity, GDP per capita, very low crime rates. You look at the worst example of Venezuela, adopting socialism. And so just like these other European cities that have adopted aggressive immigration policy, you can expect to see in New York a rise in taxes, a rise in crime, and an exodus of talent, entrepreneurs, and with that, the formation of capital and innovation. And so how does Wall Street reckon with that? The world's home to finance and capital, now being led by a socialist. Well, I think that's going to be a huge benefit to Texas and Florida. In fact, JP Morgan and many other financial companies are investing a lot more into Texas. Even the New York Stock Exchange themselves are hiring more and more people in Texas, opening branches there. There's even going to be a new Texas Stock Exchange. And we've already seen a similar thing with Chicago, the world's largest market maker, Citadel, with their founder and CEO Ken Griffin saying they had to leave Chicago and go to Miami. Their employees were getting harassed on the way to work. They literally had bullets fired at their building, and just a complete lack of upholding of the law caused an exodus from Chicago. Same with JP Morgan. They've got more employees in Texas than Chicago now, which for a long time had been the world's second home to finance after New York. But again, New York and Chicago's downfall is Dallas and Miami's benefit. We can already see New York Stock Exchange owner Intercontinental Exchange really pull back these last couple of months. Whilst the recently new IPO'd Miami International Exchange has been a bull right out the gate, and I expect it to continue outperforming New York and Chicago. Still only a small market cap under $4 billion, but you're going to see more and more talent, businesses and capital move to Dallas, move to Miami, and this is a trend that could go on for years. As like I said, I do fear that New York could go the way of London, not only in terms of taxes and crime and culture. As a lot of Englishmen will tell you, London is not really an English city anymore. I think we could be saying the same about New York, not really being an American city. And so as investors, I think it's important we take note of these key structural changes to the demographics of where our money's invested, and more importantly, support the cities that are pro-capitalism, low taxes, low regulation, which fosters innovation and technology and wealth creation. And unfortunately for New York, they'll have to find out the hard way that socialism doesn't work. You can't create wealth by dividing it, and you eventually run out of other people's money to spend. And like I said, I know I'm only a small influencer, but I believe it's important to add my voice to this issue and push back on socialism, push back on the woke ideologists and their continued pursuit to demolish Western values, culture, and capital markets that made us so great to begin with. And if you agree with all that, well, then you've come to the right place, Click Capital. And it's my pleasure to be back doing the daily market review. My name's Jared, and I'll see you again this time tomorrow. Cheers.